This content is provided solely for educational and informational purposes and does not constitute financial or investment advice. Okay. This is the first video in our series exploring IFRS and IAS standards, where we'll break down key financial reporting rules into clear, practical insights. We begin with IAS 1, presentation of financial statements, the foundation of how companies structure and communicate their financial story. So what does IAS require? IAS 1 require, and why does it matter? Let's find out. Think about it for a second. How can investors compare an asset-heavy global airline with a software-driven tech company? They operate completely different business models, yet financial reporting gives them a common language. IAS 1 provides the framework that makes financial statements structured, understandable, and comparable across companies and industries. So here is our roadmap for today. We'll cover 6 key areas: the grammar of finance, the anatomy of financial statements, core reporting principles, classifying assets and liabilities, profit, loss and equity, and finally, common errors and future changes. So let's get started. Let's jump right into section 1, the grammar of finance. So what does IAS actually do? Simply, IAS 1 tells management how to organize and present the financial story of a business. It does not calculate the individual numbers. That's the role of other IFRS standards. Instead, IAS 1 ensures those numbers are presented clearly, consistently, and meaningfully for investors, lenders, and other stakeholders. Moving on to section 2, the anatomy of financial statements. Think of this as a company's financial autobiography. Under IFRS, a complete set of financial statements includes the statement of financial position, profit or loss and OCI, changes in equity, cash flows, notes, and comparative information from the preceding period. Together, these components provide the complete financial picture. Leave one out and part of the story is missing. At the heart of the statement of financial position, commonly known as the balance sheet, is one fundamental equation: assets equals liabilities plus equity. It provides a snapshot of what the company owns, what it owes, and the residual interest of its owners at a specific point in time. But there is more to the story. Sometimes 2 years of data aren't enough. A company may need to present a third opening statement of financial position when it retrospectively applies an accounting policy, corrects a material prior period error, or makes a material retrospective reclassification. This helps readers clearly understand how those changes affected the opening comparative position. Moving on to section 3, core reporting principles, the non-negotiable grammar of financial reporting. The key number here is 12 months. IAS 1 requires management to assess whether the company can continue as a going concern, considering at least 12 months from the end of the reporting period. If material uncertainties exist, such as serious cash flow problems or loan defaults, they must be clearly disclosed. Beyond going concern, IAS 1 sets several other key principles. Financial statements use the accrual basis, recognizing transactions when they occur rather than when cash moves. Material items should be presented appropriately without obscuring important information, and offsetting assets and liabilities or income and expenses is generally prohibited unless required or permitted by an IFRS standard. That brings us to section 4, classifying assets and liabilities. The dividing line generally comes back to 12 months and the normal operating cycle. An asset or liability is typically current if it's expected to be realized, consumed, or sold, or settled within the operating cycle or within 12 months after the reporting date. So inventory taking 15 months to sell may still be current if that reflects the normal operating cycle, while cash restricted for 3 years would generally be non-current. Let's apply these rules to Pioneer Manufacturing. Unrestricted cash is current, while the factory building is clearly non-current. The loan due in 8 months is a current liability because it's payable within 12 months, and that directly affects the company's short-term liquidity position. This brings us to one of the most important rules in IAS 1. Liability classification depends on the rights that exist at the reporting date, not management's intentions. Even if management plans to refinance a loan or refinances it after year-end, the key question is whether the company had the right to defer settlement for at least 12 months at the reporting date. If not, the liability is classified as current. That brings us to Section 5, Profit, Loss, and Equity. When presenting profit or loss, companies can classify expenses in one of two ways, depending on which provides more reliable and relevant information. By nature, groups expenses such as raw materials, depreciation, and employee benefits, while by function groups them according to their purpose, such as cost of sales or administrative expenses. If the function method is used, additional information about the nature of expenses must also be disclosed. Profit or loss is not the end of the story. Total comprehensive income equals profit or loss plus other comprehensive income, or OCI. OCI captures certain gains and losses, such as some foreign currency translation differences and revaluation gains, that applicable IFRS standards require to be recognized outside profit or loss. OCI is divided into two categories. Recyclable items may later be reclassified to profit or loss, such as certain foreign currency translation differences when a foreign operation is disposed of. Non-recyclable items, such as certain revaluation gains on property, remain outside profit or loss. IAS 1 requires these two categories to be presented separately. And that brings us to Section 6, Common Errors and Future Changes. Every good story has its challenges, and IAS 1 is no exception. Common errors include claiming IFRS compliance when the requirements are not fully met, omitting comparative information, incorrectly handling covenant-related liability classification, and inappropriate offsetting of assets and liabilities. And one more important rule, items of income or expenses cannot be presented as extraordinary items. The grammar of finance is always evolving. While IAS 1 applies today, IFRS 18 will replace it from January 1, 2027 for annual reporting periods, beginning on or after that date. It introduces defined categories and new required subtotals in the statement of profit or loss, including operating profit, aiming to improve consistency and comparability across companies. That leaves us with one final thought. The rules of financial reporting are evolving toward greater clarity, consistency, and transparency. As we move from IAS 1 to IFRS 18, ask yourself, is your company's financial story ready for its next chapter? If you enjoyed this video, please like, share, and subscribe to that channel for more finance and accounting insights. Until that, keep learning, stay curious, and keep asking the right questions. See you in the next video.